I thank you, Professor Agarwal. It is a great honor to be here, great honor to see so many of you here today. We now have a panel on the view from the exchanges, and we have three very powerful, very knowledgeable people here, and I'm sure we're going to have a very rousing session. And so what I will ask you to do is to unmute yourselves, turn your videos on for the panelists, and then I will let you introduce yourselves. So who'd like to go first?
I guess I'm the first one unmuted, so I'll go first. I'm Kevin Tyrrell. I run research here at the New York Stock Exchange.
Hi, I'm Chuck Mack. I run U.S. equities for NASDAQ. Jim and Georgetown and everyone, thank you for having me at this conference. And also thank you for calling me powerful. I don't know if it was accurate. It certainly felt good.
I'll go third, and may I just say, Chuck, you're very powerful, as is Kevin. So thank you. I'm Nandini Sukumal from the World Federation of Exchanges. We represent market infrastructures around the world, around 300, ranging. We have a third of our membership in the Americas, and NASDAQ and NYSE ICE are two distinguished members. We represent about a third of our membership are in Asia Pacific. We range there quite widely from Australia right through to Colombo, the Colombo Stock Exchange, which is a frontier market, and of course in EMEA, where we count Europe, continental Europe, the UK, Middle East, and Africa. So the view, I think, in terms of the view from the exchanges, we offer the global perspective.
And we certainly do have the global perspective here today. So first, let's talk about what are the big issues in market structure these days. So anyways, Nandini, do you want to give us the global perspective on that?
I will give you the global perspective. So Jim, introducing this, and I want to note that, both Charles and Kevin have contributed very significantly to that global perspective, and maybe a little later we'll have an opportunity to talk about some of the work we're doing around volatility, in which Kevin is and his team have been very much involved, as has NASDAQ. But every year we go through a process where we choose 6 priorities for the year. Sometimes it's 5, sometimes it's 6. And I'm quite comfortable saying that those priorities represent the universal touch points for the market infrastructure industry across the world. It's a very rigorous process we go through to identify our priorities. To give you a snapshot, in the 6 for 2021 were first, operational resilience and that agenda, which spans volatility, managing volatility, short selling, all talking about, keeping markets open, that whole resilience agenda, which has been to the fore during the last 2 years now almost. We have a priority around the role of our industry in inclusive growth and building back better. That touches both the retail conversations we will undoubtedly have in this session, and ESG, which is coming later. We gave ESG a whole separate priority area because clearly it is of the moment, where we are doing a lot of work. I think Rena expressed very interestingly, I mean, she wrote a lot of the kind of foundational work that our industry has learned from on corporate governance. So absolutely ESG and the role of the industry there. Market data, which I hope we will absolutely have an opportunity to discuss. CCP capital loss allocation issues. We cannot have as an industry a conversation in which exchange doesn't talk about, we have to talk about trading and post-trading. We need to have a holistic view. And then finally this year, we chose financial literacy and investor protection. And this was before the whole meme stock phenomena. So I think we kind of we have our finger on the pulse. I think financial literacy and investor education and protection is actually going to become more and more important as we ride the wave of retail participation that has already started.
Thank you. Kevin, do you want to add to that?
Sure. Maybe I'll drill in a little bit on the U.S. since that's where NYSE obviously is focused. And there's a lot of talk about resiliency. I think the markets have proven themselves incredibly resilient, at least the U.S. cash markets, over the last almost 2 years now. And while there's been a lot of debate and a lot of criticism over certain practices in the market, I think the big picture is the market infrastructure and the market participants really responded as they were supposed to, and allowed price discovery to occur during events like the COVID pandemic, where we had circuit breakers for the first time, which we worked with WFE on some issues there. And things like the meme stocks, the markets function in a very deterministic way where everyone kind of knew what was going to happen, and the infrastructure behaved the way it was supposed to. And that's a very positive sign. And it is because the industry collectively has worked very hard over the last several years to be prepared for something like that. When we get into a little bit more, kind of finer detail on, if we look at things like what happened earlier this year with some of the jumps in specific securities from retail firms and others, I think it highlights some areas where you may be able to improve market quality. We've pointed out a few of these publicly, and things like congressional testimony. We think there's some modernizations you can make to holdings disclosures, which are right now still based on a very dated set of technology and an approach that's really from the 70s around disclosing who kind of has a position in a company. We think there's some other modernizations, some of which are already underway. Clearing to T+1 seems like pretty much everyone's on board with that. That seems like it would make sense and just reduces some risk. So that seems to be widely accepted as a positive step and something to do. We pointed out that the securities lending market remains very opaque and could really stand some modernization, and we think that might have helped address some of the confusion that surrounded things that were going on in January. And then finally, on the trading side, we do think some of these active securities, some of the trading that we're seeing in the market lately has really highlighted the discrepancy between the on-exchange and off-exchange trading rules and the much higher degree of flexibility off-exchange venues have. And we think that does hinder to some degree price discovery. And we think there's certainly a case to be made for tightening that discrepancy or minimizing that discrepancy between on and off exchange. When you look at things that are trading very actively, you see some stocks that are very clearly tick constrained by the one size fits all tick rule. And we think that's something worth revisiting.
Thank you. That's quite a lot. We could talk the entire day on these issues. Chuck, what would you like to add?
Between my fellow panelists, you guys covered a lot. So I'll just add two quick thoughts. One, overall, I don't think there are big issues that are major issues that are causing big problems in the market. So I don't think we're in a bad place right now. And we already highlighted the resiliency of the market and how we performed under pressure, and I think that's really good. So I think what you want to do is take a look at the market and make sure you don't kind of break stuff that works really well now, and say, how can we make iterative change where there's things that could be fine-tuned and bring it forward. And Kevin touched on a couple interesting things. We've got clearance and settlement, which the industry is tremendously optimized around the structure we have today. It's intertwined in everybody's systems, and big firms like banks have 500 systems to deal with when they want to make changes and that kind of thing. So I think it's a good thing to want to optimize and make more efficient, but I do think we need to be careful and make sure we don't break something major along the way. And the same would go for securities lending and maybe some of the more or less transparent pieces of the market. Let's bring some light there and make it more transparent and make sure we continue that march towards efficiency, which has continued to drive positive effects in the equities markets.
Thank you. Now, I've heard everybody talk about the resiliency of the market, and indeed it's something to be proud of. One thing I think many of our participants don't really appreciate is just how hard our exchanges work behind the scenes. Virtually every other weekend, there is weekend testing where the operations people are spending their weekends running scripts, testing hardware, testing new functionality to make sure that it doesn't break when the market is open. But I also heard meme stocks. GameStop. What have we learned from this situation? Does the meme stock situation illustrate any cracks in our market structure? And if so, what, if anything, should we do about it? Who'd like to take that one?
Well, I'll start, but I'm sure Kevin has some interesting research behind that. I would say if that event highlighted something with the market structure, the infrastructure, the plumbing, I think it was mostly that it worked really well. I think it was the height of that was the most volume we had ever done in the history of the markets. So that's pretty impressive. If I think back to, I'm gonna date myself, but I'm gonna go all the way back to when Rule 611 was being implemented for Reg NMS in 2005, 6, and 7. And they had this little piece of that rule called self-help. If a venue was having trouble with their technology, you could self-help them and ignore their quote, even though normally you wouldn't be able to trade through their quote. And that was happening once a week. People were having problems with their technology all the time. And that was at a minute fraction of the transactions that we handle today. So I'd say how well we've come along as an industry is just tremendous. And so I think the meme stock events highlighted that. Now there are maybe some of the things like we already touched on with regards to clearance and settlement. I think there was some misunderstandings around how that works and why it works that way, and I can understand that. If I'm a new investor coming into the market in the year 2020 or 2021. It's kind of unclear to me why, I can't have my stock immediately. Well, it takes 2 days to clear and settle, and that's how it is. And we have an optimized system around that. And we should probably work towards changing that. But I think most of the concern there and cracks, if you will, was more around misunderstanding than it was something fundamentally wrong with the market structure.
I guess maybe I'll pick up. I would extend that to the securities lending market too. I know I mentioned it already, but there were, as bits of information came out about short positions and short interest, there seemed to be a lot of confusion driven by that, and that obviously contributed at least to a lot of the chatter around things. Whether or not it contributed to the activity, I think is harder to say. So I think that's something where we could improve. I also just more generally I don't know that the meme stock events or whatever were transformative or anything. I think the changes that we've seen in the market really started last May of 2020 or so. Maybe it peaked in January and February, but we've seen this growth in retail activity. We've seen how it changes the stocks that are active, when stocks are trading. We've looked a lot at just how the options market and the equities market interact, and how activity in the options market can shift even when and where activity is taking place in the equities market. So I think a lot of that was already well in motion when GameStop and AMC got really active. I think probably the biggest issue is I don't think it's necessarily a regulatory thing. I think it's something for market participants to really start understanding how things may be different now. And when you see some amount of liquidity on the tape, for instance, it's not necessarily reflective of your ability to execute in that security, especially if you're trading outside of the S&P 500 or some of these other widely held type of securities that are in indexes and things like that. And that's something we see. I mean, that's going on today. I looked before we started today, and I think the top 10 symbols by volume were 8 symbols under $10 a share and 2 electric vehicle makers. And that's kind of the nature of the most active stocks in the market these days. So that's resulted in people changing their tools. I don't think it necessarily calls for a massive regulatory overhaul or anything like that, though.
And
Jim, if I might just say kind of two things really as a follow-up to both Kevin and to Chuck. I really take Kevin's point. I think he's absolutely spot on when he talked about how the meme stock wasn't necessarily a transformative moment, but that the changes had been occurring in the year before. We have a significant retail investor participation work plan, and one of the things we did for it was we surveyed our members, and we've dated, for the last 5 years, retail participation has been growing steadily, and pretty much every exchange in our survey basically said that they expect retail participation to continue to grow. At the beginning of the pandemic, when we had an extraordinary board meeting to talk about, what was happening in market structure, what was happening in public markets around the world, our board met regularly, every 2-3 months through the pandemic, so that there was senior, high-level strategic leadership in addition to what every individual exchange and CCP was doing on the ground in real time. One of the first things that cropped up was, and this was the start of the pandemic, was the rise of retail and the role that retail was going to play. And with that came also, on the first hand, I think it's very welcome, because for most public markets, retail is the holy grail, right? If we can, bring retail into the market, that's a more inclusive market. But there's also, if you're an exchange, a public market where investor protection is in your DNA, there's almost, you're also cautious because how difficult that is, because many of the things that occur and continue to occur, however many times you say it as a public market, investor education and understanding of the way that financial markets and public markets work is not at all perfect. I would say, it was pretty suboptimal, actually. And I think that, if anything, one of the things that the GameStop phenomena has demonstrated is how much, more work there needs to be, not only from exchanges, but from the entire capital market ecosystem, on financial literacy, investor education, and some of the issues around there. But, inclusive growth needs retail participation. One other point, I think, just to go back to the point about kind of resilience and what it taught and what the phenomena taught us about resilience. I want to give you a number, and that is between, for the last 5 years, between 2015 and 2019, exchanges in general, or on average, handled 31 million trades per month. I mean, it's an average across the industry. Some will be, of course, much more than that. Some will be much lower. And then they handled 53.6 million trades per month during the year 2020. So that just gives you a sense of kind of the step change that occurred in volume and in volatility. I mean, it's a 73% increase in the number of trades. And in the first half of 2020, which was really the beginning, if you like, of the pandemic and the pandemic-induced volatility, and you compare that with the second half of 2019, equity markets saw, on average, record high levels of value traded. The value traded on average, rose 50%. And volumes grew 47% on average. And that's from one half to the other. And through it all, markets remained resilient. They were robust. They remained open for business despite calls in many parts of the world, for exchanges, for public markets to close, to tame that volatility. And they did what they were supposed to do, which is they helped companies raise finance, and they helped companies and industry participants hedge risk. So those two core functions of the exchange and the CCP, were absolutely, at the heart of it, and they functioned as they were supposed to. Can resilience be improved? I mean, resilience should never be a fixed point. It should never be, we've got here and that's all we've got to do. There always needs to be, it's like a journey. We'll spend, if we were all alive in 100 years, I hope we would be speaking about resilience and how it could be better.
Well, with advances in medical technology, we just might be around 100 years from now. Although I suspect 100 years from now, our descendants will probably be debating a lot of the same issues that we're debating now. But one of the things that came out of the pandemic was an increased attention on payment for order flow. And there are calls to change or restrict or even ban the practice. And Nandini, let's start with what's happening around the world with payment for order flow.
So this one, I mean, it's really an interesting question, and I'm going to ask Kevin and Chuck to speak, much more to it. But really, I mean, payment for order flow, it exists in the US. It does. There are other markets in which it doesn't exist. And really, in thinking about it, the message we would say globally is every country needs to have a market structure that benefits it, right? So what's right for one country may not necessarily be right for another country, may not be right for another jurisdiction. But in thinking about market structure in general, what I would say is beware of the one-size-fits-all approach. There are markets, the US is pretty unique in having payment for order flow. In Europe, they're going so far as to ban it. It doesn't exist in the UK. Most emerging and frontier markets don't have it.
And yet, one of the things we're very proud of in the US is the fact that international studies of transaction costs say that our transaction costs are the lowest in the world. So,
and it's been good for the US market,
Yeah.
The retail investors, and I'm going to ask, Chuck and Kevin to speak to that, running, US markets. And that's why we would always say to you, don't kind of go with a one-size-fits-all approach. I mean, I think payment for order flow has brought benefit to the US market, and I leave the US markets to answer that point as they wish.
Yeah, I guess maybe I'll just pick up there. I think the challenge is, kind of to Nandini's point. There's never been any. I think there's very little evidence that it's harmful. You probably come up with a lot more evidence that it's positive. And I think especially if you look holistically, a lot of times this conversation ends up in details around, the width of the quoted spread in the market. But I think you're starting to see people think a little bit more holistically around what does this mean for the actual front to back experience for people and what people really care about. I think one of the challenges with banning, my assumption is that there will not be a ban on payment for order flow, and that's pretty broad. It would be a pretty big leap. You'd have to probably have uncovered some evidence that has yet to be uncovered in the market. The SEC has a pretty high bar in terms of what they must evaluate, what they must do in terms of evaluating cost benefit and alternatives to implementing policy. And it would be a pretty dramatic change from existing practice to suddenly ban this. I do think one thing that we've noticed in some of the conversations, or really it's been speeches so far from the chair and others, is that there is more of a linking or just kind of a grouping of payment for order flow with exchange rebates, which I think indicates if they are thinking, whatever they're thinking about doing, it'll probably be fairly holistic, and it won't be something targeted just towards this very specific business model of wholesaler versus and online broker. It'll be a little bit more broad of, if you send order flow somewhere and get something in return, what do you have to do around controls and transparency with that?
I would say as well, if I may, Kevin, that while I think pretty much, it's right, always people should be, regulators should feel free to look, at market structure. I think that payment for order flow should absolutely not be confused with exchange rebates.
Yeah, if I could just add a little bit there, I would say, one, just to kind of think about what payment for order flow is. It's a bilateral agreement, a commercial agreement by two entities that's mutually beneficial to each of them. So, and the other part of it is essentially a retail broker is outsourcing a part of the business to a retail market maker. And what that allows them to do is focus really heavily on what they're good at. And it allows the market maker to focus really heavily on what they're good at. And so, as Kevin mentioned, it's generally a very good outcome for individual retail investors. I think challenges come in because, if you don't really understand how it works, it gives you this sort of uncomfortable feeling that there's a conflict there. And obviously there is a conflict, and we just need to make sure that the conflicts are managed and mitigated. And I usually think of the way to deal with that is to shed some light on it and have some transparency around it. There's a decent amount of transparency around it already. There's probably a couple things we could enhance to make it a little better and alleviate that perception. Two other thoughts there. One, it's probably works better in the US than maybe some other places because the US is massive. It's just a massive market. And so there's room for a lot of different ways of transacting within the market. And then two, I want to sort of reiterate Nandini's point that you want to be careful about being overly prescriptive. You want to be careful about focusing in only one minute area and doing something draconian. Really, what you want to look at is what things could we change? Going back to what I said earlier, like what iterative changes can we make that's going to be a benefit to the market as a whole? For me, when it comes to payment for order flow, it's more about transparency around it than it is about changing the practice or completely undoing existing business models in the market, which seem to work pretty well.
And as a retail investor, I feel that I truly benefit from payment for order flow because it's orders from people like me that are worth the most. But there are, again, it's banned in some countries and some people are calling for bans here. If there were a ban, should it also apply to exchange rebates? And if not, why not?
I think Nandini kind of touched on that point that she said you shouldn't confuse payment for order flow with exchange rebates. And I think that's right. They're two separate things. You have to think about them completely separate. I mentioned that payment for order flow is a bilateral commercial agreement between two entities. Exchange rebates, at least I know how it works in the US, is approved by the SEC and available to anyone who wants to provide liquidity on the exchange. More importantly, if you're going to look at rebates specifically, you have to think about it in the context of ensuring we continue to have sort of that low friction, high liquidity, high visibility based market. We have really good spreads in our market. We have a lot of liquidity on the screen, and that's really, really important. That drives so much in the market. And I think we tend to take that for granted to some degree, and we just have to keep that in mind how important that is. And for us, we spend a lot of our rebate resources on making sure the market quality on our exchanges are good. We have multiple market quality specific programs where you meet some requirements such as quote quality, time at the best price, and all that kind of thing, and we provide you a reward for that. And we find it's very effective, and we think that's super important to the market. Separately, and that's sort of like a liquidity provider or market maker type incentive program, although it's available to everyone. The other way to think about it is it's a great mechanism to gather liquidity. And that's very, very valuable to the market. I mean, we one of the things we talk about a lot is how much liquidity we have on our book and on the screens, and just how important that is. And so rebates enable us to do that. There may be other ways to do it too, but the rebates are really valuable and effective in achieving that goal.
I mean, I think I'd agree with all that. I guess I would also just point out, if you try to ban something, I mean, that's, as we've said, it's incredibly prescriptive. I'm sure there are many ways around it for all these highly innovative new fintech companies that are starting online brokerages and app-based brokerages. I'm sure they will find different business models that can yield positive economics. So I think trying to focus on doing something like a ban is a lot of effort. It probably won't be very successful in achieving the end goal. And I think part of the issue with bringing things up like banning PFOF or talking about exchange rebates is like, what is the goal of that? Chuck mentioned the liquidity, the market quality we have in U.S. markets, and this is a lot of these issues came up when the SEC passed the transaction fee pilot. If the objection to what's going on in the retail space is that a lot of trading is taking place off exchange, I think that needs to be said, and then we can try to address that issue. If the issue is there's this potential conflict of interest between two entities in this bilateral relationship, that's sort of a different, you can approach that differently and have different remedies for that. I think to this point, I don't know if everyone's agreed what, if anything, the issue is. And I think we need to do that before we say, okay, this is what we're going to do in reaction to it.
That's an excellent point. And speaking about agreeing on what the issue is, no discussion of market structure is ever complete without talking about market data. So, what are your thoughts on the never-ending market data wars? Now, we've been fighting over market data literally for over a century. You can go back and see court cases from 100 years ago of people arguing about the ticker tape. And we see, very different things happening in the US and in Europe and in other parts of the world. So why don't we start with the US and then move elsewhere. Who wants to tackle the market data beast?
I'll just say two quick things. One, I think in the US, the availability of market data has been a big part of what I was just talking about with regards to the transparency in the market. I would say that that information has a tremendous amount of value, and the amount of value, varies by the venue producing that data. And so I think what you have is a fairly competitive market where there's different venues providing data at different prices. And then we have in the United States the consolidated tape and the consolidated quote feed. And when it was implemented, it was certainly a great thing where you had some challenges with competition. You had, I wouldn't say monopolies, but you had some strong players had a lot of control over the market. So that democratized access to data to some degree. But it was really the more on the proprietary side where you saw innovation and you saw new value coming out. And so I think we need to make sure that we have a system built that supports that and drives innovation, that kind of thing.
And I would agree with that. I think that was well said. I would add that, in our current regulatory environment for the U.S. market overall, not just market data, we have the regulatory environment that has led to a lot of fragmentation, both of on-exchange and off-exchange venues. A lot of market data, efforts involve trying to put the market back together. So I think that's just something worth keeping in mind. The use of market data has changed over time. The products have changed, and a lot of that has been in response to the way the market has evolved, kind of organically, but also the way the market has been told to evolve per SEC policy.
And I think that's a very important point, that we use market data to stitch the market together. As they say, data is the new oil. And but I find it rather odd that we're going from or the SEC is trying to push us in a direction of competing consolidators for market data. At the same time that Europe is attempting to put in a consolidated tape. So Nandini, what's going on there?
Actually, if I could answer for a moment, from the global perspective, and I wanted, in thinking about market data, for us to look at the fundamentals, look at the conceptual construction that we have and the fundamentals of the debate, if you like. I'm pleased to hear that I was pleased to hear that you mentioned that the arguments had been going on for a century. I think some of those early court documents will make for fascinating conversation and fascinating reading. I suspect that the arguments haven't changed much, right? I would say, if you think about it conceptually, market data is created by the exchanges. There would be no market data if the exchanges didn't create it. And the exchanges create it every second, every minute, or every day that public markets remain open by virtue of all the things that they do. all the work they do to enable price discovery, transparency, liquidity, all the things that the exchange does as part of its DNA. That goes to creating the market data that everyone is arguing about. It's a bilateral commercial conversation that is being dragged into a public policy debate for self-interested reasons. And I will be as kind of blunt as that. There's plenty of free data around the world. You can go to the WFE website if you like and get free data. Much of the world does. And nobody wants somehow this conversation about market data. I mean, most market data around the world is available for free, 15 minutes with a 15-minute delay. That's extraordinary if you look at the investment that goes into creating that market data, the investment that the exchange has put in to creating a market, a public market that is inclusive, easy to access, open to all, regulated, transparent, where there's a rule book that's published, where the exchange, the market infrastructure is accountable, where there's investor protection as part of the DNA, etc. It's extraordinary, that you get free market data 15 minutes after. But you know what? Nobody wants that data. They all want the data that is of value that Chuck talked about. And so therefore, why do you want that data? What are you doing with the data that you need it so quickly? And I would say to you, answering that question gives you, a really fundamental truth again, which is the people who want that data and claim it's priced too high and it should be done a different way, sliced and diced and distributed and priced a different way, are all people who are making substantial revenue from that exchange market data. So I hope that gives you the global perspective on market data.
And I just want to emphasize what you said about the fact that market data is intellectual property. And in a world where we're paying ever more attention to copyrights, patents, and intellectual property, when we talk about transparency, we are really talking about breaching people's rights of financial privacy and rights to their own intellectual property that they've often expended great amounts of resources to actually acquire and create. And so that definitely needs to be part of the debate. But we could talk about this for centuries, yes. But tomorrow we're having not one, but 2 sessions on digital assets and cryptocurrencies. But I want to jump the gun and see what's happening with cryptos from your perspective.
I mean, we've got this situation where traditional finance and crypto finance are at least touching each other a bit, where you've got 3 ETFs now that are based on Bitcoin futures. There were 2 launched a couple of weeks ago and one launching today. I think that's an interesting development. I think we're really early days on what's going on in that space. And I think about just to take a step back for a second, I think about the last time we saw change in the market or fundamental change. It was about technology changing. And so I see new technologies emerging, and some are really new, some are newish. I think of blockchain obviously has some interesting potential. We were talking about clearance and settlement before, like maybe there's some applications there. You've got cloud technology, which is being adopted more and more, and I think we'll see that trend continue. And so, the story is yet to be written with regards to crypto and the blockchain, but I do think, it'll be something we're talking about for a few years before the book is shut on that.
I think it also relates back to a lot of the conversation we just had about retail too. You're introducing people to this other way of, the financial world to some extent, with a lot of, very different assumptions, and they're kind of translating that over to the cash equities market and other markets, right? Like, why should I need to buy, a full share of something that's $2,000 a share when I can buy, whatever it is. I don't even know what a Satoshi is, but it's a very small dollar amount. So I think you're going to see it. I think that's going to just bring more and more demands for changes into the cash equities market, and we'll see how it develops. It's going to run into an existing regulatory structure, and there'll be a lot of kind of one-on-one battles, I guess, on different issues.
So I would say, Justin, I think there's not much to add to both those very interesting perspectives. But it's just to say that crypto in many ways, it's a new asset class. You don't have new asset classes that come along that often. As an industry, we should be thinking, and we are thinking about how you can trade it in an exchange environment, because that is the safest and the best way to trade any asset class. I think that there needs to be much clearer delineation between, right now, every crypto platform in the world calls itself an exchange. And the reality is what you're getting when you come to an exchange market. It's so different that I can't even, when I get asked the question, I just think, oh my gosh, there's a quantum difference between coming to a public market and between a platform. And I think it's really good. We don't get new asset classes that often. You'll find a lot of debate around one when one emerges. I hope in not in 100 years, but maybe even next year, we'll be having quite a nuanced conversation about how crypto has been able to translate into an exchange space, and how investors are able, to participate and benefit from some of the virtues that you get with a public market. I would also say, and just as an anecdote, but to give you a sense, there are obviously multiple platforms around the world. At some point, we've been at the WFE, we're approached pretty much by every single one of them, because they all want to come and join an exchange association, to prove that they are, really an exchange. So if you want to be an exchange, if you want to trade an offer for trading thing, you should behave and have the same responsibilities that a public market does. And I think for the most part, regulators and policymakers understand that.
Now, speaking of new assets, we've had a boom in new listings, IPOs, direct listings, and SPACs. Now, is this a temporary pandemic bubble phenomenon, or do you think we have actually had a regime shift from that long period where we saw the number of listings steadily deteriorate, especially in the US markets?
I think there's a few things going on here, Jim. It's not just because we've got more investors in the market, which, by the way, is a great thing. It's great that we've seen a lot more retail come into the market, a lot more, regardless of what their investment strategy is. But there are a lot of things that are driving it. I think there's record levels of venture capital in the market, right? There's new vehicles, like you mentioned SPACs. There's different ways you can come to market. There were some positive regulatory shifts as well. For example, proxy and that kind of stuff around voting that made it a little bit less burdensome to become a public company. So all these things, you've got interest rates, you've got many different things driving what we're seeing. Certainly, one of them is part of what you mentioned. We've got a lot of exuberance in the market and enthusiasm there. And so, if I were a company, I would be eager to participate in that as well. But I do think if I don't know how many things I named, but let's just say it was 5. I think if you get 3 of the 5 to stick around, I think we'll continue to see a really healthy public capital market continue. The thing that probably concerns me the most is around regulation. I know that disclosure and transparency is really important, and I buy into that 100%. But I also know that the more burden you put on a public company, the less likely they are to come public. And so we just need to make sure we're conscious of that balance. Obviously, there's there's a benefit to having the obligations on the public companies. You know what you're getting in a public company. It's much more safe. Not that it's safe. There is risk, obviously, but there's more understanding and transparency about what you're investing in than versus a private company, for example. The flip side is, with so much venture capital, and you have companies coming to market really late, which we did prior to the pandemic. The rest of us in the market, the mom and pops, can't really get in on that positive growth early in the life cycle of that company. But there's risk there too. Right? You have to recognize there's the risk side too. Not every company is a unicorn. So for me, I think it'll stick around to some degree, but it really depends a lot on these different things and macro, where interest rates go and all that kind of stuff. So I think it'll temper to some degree, but I do think it's a bit of a shift pending legislation. If legislation changes everything, then all bets are off.
I agree with all that. I think the tools that you mentioned, Jim, specifically SPACs and direct listings, are certainly here to stay. SPACs, there's, I guess, the regulatory outlook for anything is always on some degree uncertain, but it seems like SPACs, there are still SPACs coming to market. It slowed down from the blistering pace it was on previously, but I think that's proven to be a really helpful tool to get some of these earlier stage companies into the public markets. And direct listings is a really, I think, targeted tool. It's very helpful for companies where it's a fit. It's a really great fit. And I think just having this menu of options for companies is also just going to encourage more and more firms to at least start the process and think about getting public and hopefully keeping that trend you mentioned of declining public companies from coming back.
Now, I know we have lots of questions in the Q&A and we only have 2 minutes left. So I'm going to apologize to all the great questions because, again, we have so many great topics we could be talking about for the entire day. But I'll point out that we have FINRA CEO Robert Cook about to join us at 1 o'clock. And if you were to ask Robert Cook a question or wanted to put something before him, what would you say?
I would love to know two things. I think one would be, what keeps him up at night, which is always a fun question to ask and answer. And then the other, I think, is a really big challenge that, any regulator or anyone sitting in his seat has, which is, how do you sort of have that balance? It kind of is related to the point I made about listed companies. How do you have that balance between the right level of regulation, the right level of guardrails, making sure companies are doing what they're supposed to, make sure you're catching the bad guys, if you will, but also at the same time not putting an undue burden on firms so they can't compete as well, or you create a barrier around the biggest firms because they're the only ones that can afford all the lawyers to deal with all the compliance. It's a very difficult balance, I think, to make sure you have as a regulator, because you obviously want to catch every single bad guy, right? And so I'd love to hear from him on his thoughts on that.
All right, and let's do a final lightning round for the three of you. 20 seconds or less. What keeps you up at night?
Easy for me. It's all the macro things, the things that are outside of your control that it's very hard to plan for. I think that's what keeps me up at night.
I'll go next. How do you nurture public markets so that they continue to remain with you as a force for good? Because I think at the moment we are not nurturing our public markets. We're not supporting our public markets enough. We're taking them for granted.
I would maybe build off that a little bit. I would worry if we have a meme stock thing that went in the wrong direction, or if we have cryptocurrencies blowing up. I feel like there's some probably low probability but high impact events that could happen that could really turn a generation of people off from investing if we don't get the regulation right.
Great. And it's now time for FINRA CEO Robert Cook. So I will turn it over to Professor Agarwal. I want to thank our panelists and our audience, and once again apologize that we couldn't get to all of the great questions in the Q&A. Take it away, Professor Agarwal.